Welcome back to the channel. I'm Algabot, and today we're studying an expert advisor for MetaTrader 5 called Impulse Zone Reversion. This is an educational breakdown, not financial advice. This strategy blends two classic ideas, supply and demand zones, and the Relative Strength Index, or RSI, as a momentum filter. By the end of this video, you'll understand how the strategy reads a strong directional candle, marks the imbalance it leaves behind, and then waits patiently for price to return into that zone before signaling a mean reverting trade. Let's walk through the logic together, look at the actual code, and follow it on a chart. Let's start with the big picture. Impulse zone reversion is a mean reversion strategy. That means instead of chasing a move, it waits for price to stretch away and then come back to a level where, historically, supply and demand can rebalance. The strategy can run on any symbol and any time frame you attach it to in MetaTrader 5, since it works purely from price candles and two standard indicators. The core concept is the impulse candle. When the market produces a strong, decisive bar, the strategy treats that as a footprint of large participants stepping into the market. A strong bullish bar is read as institutional buying that left a demand zone behind it at the candle's origin. A strong bearish bar is read as selling that left a supply zone behind it. The threshold for what counts as strong is measured against the average true range, or ATR, so the definition adapts automatically to how volatile the market currently is. The second ingredient is the RSI. RSI measures momentum on a scale from 0 to 100. The strategy uses it as a confirmation filter, not as a standalone trigger. It only considers a long when momentum is depressed, and only considers a short when momentum is elevated. This pairing of structure plus momentum is the heart of the approach. So who is this style of analysis suited for, from an educational standpoint? It tends to appeal to traders who prefer patience over frequency, who like clear, rule-based setups, and who want every entry to have a defined stop and a defined target before the trade is even placed. The strategy makes one decision per completed bar, so it isn't reacting to every tick of noise. And remember, like any approach, this strategy can and does produce losing trades. Trading carries real risk, and nothing here is a promise of any particular outcome. This is for learning purposes only. Let's go through the exact logic step by step. Every time a bar closes, the strategy measures that bar's body, the distance from its open to its close. It compares that body to the ATR multiplied by the ImpulseAtrMult input, which defaults to 1.5. If the body is larger than that threshold, the bar qualifies as an impulse. A bullish impulse stamps a demand zone. The zone runs from the candle's low up to its open, the origin of the move. A bearish impulse stamps a supply zone, running from the candle's open up to its high. The strategy keeps the most recent demand zone and the most recent supply zone on file, and importantly, marks each as fresh and in use. Now the strategy waits for price to return. For a long signal, for conditions must all line up on a single closed bar while no position is open. First, there must be an active and used demand zone. Second, the bar's low must dip into that zone. Third, the bar must close back above the bottom of the zone and close higher than it opened, a bullish reaction. And fourth, the RSI must be at or below the RsiLong level, which defaults to 45, confirming depressed momentum. When all four agree, the strategy signals a buy at the ask price. The short signal is the mirror image. With an active and used supply zone, the bar's high must poke into the zone. The bar must close back below the top of the zone and close lower than it opened, and the RSI must be at or above the RsiShort level of 55. When that aligns, the strategy signals a sell at the bid. Risk control is built in before each order. For a long, the stop loss sits below the bottom of the demand zone, padded by RsiLong times the ATR, 1.2 by default. The distance from entry to that stop is the risk. The take profit is placed at that risk multiplied by the TpRrMult input, which defaults to 1.8, giving a reward to risk of 1.8 to 1. Shorts use the same math, mirrored above the supply zone. Finally, two housekeeping rules keep signals clean. Each zone can trigger only one trade. And if price closes completely through a zone, that zone is considered broken and is discarded immediately, so the strategy never chases an exhausted move. Let's read the actual meta-editor code on screen. At the top are the inputs you can tune. RSI period, defaulting to 14, sets the RSI lookback. RsiLong at 45 and RsiShort at 55 are the momentum thresholds. ATR period is the volatility lookback. ImpulseAtrMult multiple of 1.5 defines how large an impulse body must be. RsiLong multiple of 1.2 pads the stop, and TpRrMult multiple of 1.8 sets the reward to risk on the target. Lots is the order volume. Now the long block. Notice the chain of conditions joined by logical ANDs. The demand zone must be active and in use. The candle's low must reach into the top of the zone. Its close must hold above the zone's base. The close must be above the open, and the RSI must be at or below RsiLong. When every part is true, entry is read from the ask price. The stop is set just below the demand zone's base by 1.2 times ATR. The risk is the gap between them, and the take profit is that risk multiplied by 1.8. The order then fires through trade.buy. The short block, in the else if, is the exact mirror. The supply zone must be active and in use. The high must poke into it. The close must stay below the zone's top. The close must be below the open, and the RSI must be at or above RsiShort. Entry comes from the bid. The stop sits above the supply zone padded by ATR, and trade.sell places the order with its matching take profit. This is educational only. Let's bring this to life on the chart, candle by candle, following one long trade and then one short trade. Underneath the price, you can see the RSI subpanel, with the green RsiLong line at 45, the gray midline at 50, and the red RsiShort line at 55. Watch the first two candles. Price drifts gently lower, and the RSI eases down toward 44. Nothing actionable yet. The strategy is simply observing. Then the third candle changes everything. It's a tall, decisive bullish bar, and its body easily clears the impulse threshold of 1.5 times ATR. The strategy reads this as demand stepping in, and it immediately stamps a demand zone at the candle's origin. You can see that zone marked on screen between the demand zone base and the demand zone top dashed green lines, sitting right where that strong candle began. Now the strategy waits for price to come back. The fourth candle pulls higher first. Then the next bar drifts down and dips its low right into the demand zone. This is the moment of truth. That bar reaches into the zone, but it closes back up above the zone's base. It closes higher than it opened. And crucially, look at the RSI. It has dropped to 43, at or below the RsiLong level of 45. Every condition agrees, and the buy entry marker prints. Notice the logic here. We're buying weakness into a fresh demand zone, with momentum depressed, expecting a rebalance back upward. The stop would sit just below the base of the demand zone, padded by ATR, and the target is set at 1.8 times that risk. From there, follow the reaction. The next candle pushes up off the zone, then another, and momentum builds. The RSI climbs back through 50 and on toward 70. Price runs cleanly into the take profit marker on the eighth candle. That completes the long, a dip into demand, a confirmed bullish reaction, and a controlled run to the target. Now the market flips, and we get our short example. Look at that same eighth candle from the other side. It opens high and sells off hard into a tall bearish body, once again clearing the impulse threshold. This time the strategy stamps a supply zone at its origin, shown between the supply zone base and the supply zone top, dashed red lines near the top of the move. Price then rallies back up to test that supply. The candles climb, and on the 11th bar the high pokes up into the supply zone. But watch the reaction. The bar closes back below the top of the zone. It closes lower than it opened, and the RSI has lifted to 58, at or above the RsiShort level of 55. That elevated momentum into a fresh supply zone is exactly the confirmation the strategy wants, and the sell entry marker fires. The stop would sit just above the top of the supply zone, again padded by ATR, with the target a 1.8 reward to risk multiple below the entry. From the sell marker, price rolls over. The following candles step lower. The RSI slides down through 50 and toward 30, and price reaches the second take profit marker on the final candle. There you have the full cycle. An impulse builds a zone, price returns into it. RSI confirms the momentum, and the strategy signals a mean reverting trade with its stop and target defined in advance. Remember, this is an illustration for learning. Real markets also produce setups that fail, and losses are part of trading. That brings us to the end of our breakdown of impulse zone reversion. We covered how the strategy detects a strong impulse candle, how it carves a demand or supply zone at that candle's origin, and how it waits for price to return into a fresh zone with RSI, confirming the momentum before signaling a long or a short. We also walked through the ATR-based stop and the fixed reward to risk target, and we saw both a buy and a sell example play out on the chart. Everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like me to break down next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.